Australia has the world's third highest rate of crypto adoption. According to Finder's survey, Australia has the third highest rate of cryptocurrency ownership above 17%. Australia is more bullish on cryptocurrencies than the majority of other countries, according to a survey published Sunday by comparison website Finder. The survey, which is based on the site's Cryptocurrency Adoption Index, tracks the global adoption of cryptocurrency through a regular survey of over 41,600 individuals in 22 countries. Australia, according to Finder's survey, has the third highest rate of cryptocurrency ownership at 17.8%, trailing only Indonesia, 16.7%, and Hong Kong, a special administrative region of China, 15.8%. According to Finder's results, the global average is approximately 11.4%. Australians adore gambling, Finder CEO Fred Schuester told CoinDesk via Signal on Monday. They are also extremely financially savvy. The laws governing cryptocurrency make it extremely easy to buy and sell. Finder discovered that Bitcoin is the most popular cryptocurrency in Australia, with 65.2% of Australians owning the world's largest cryptocurrency, the fifth highest percentage among the 22 countries surveyed. Meanwhile, Ethereum is the second most popular coin in the island nation, accounting for 42.1% of the market, while Cardano accounts for 26.4%. Dogecoin and Binance Coin are two additional cryptos that Australian crypto owners currently hold at a rate of 23% and 14.6%, respectively, according to Finder's results. Banking in Australia is extremely easy and convenient, Schuester added. Other countries have significantly more regulations and barriers to entry and exit from crypto. The risk-free cryptocurrency trade is making a comeback in a big way. The spread between Bitcoin futures and the current price of the digital currency offers the highest annualized return over the next 5 months. The closest thing to a risk-free bet has resurfaced in the cryptocurrency market, as traders bid up the price of futures in anticipation of the launch of the first Bitcoin exchange-traded fund. According to data from FRNT Financial, the spread between Bitcoin futures and the digital currency's price offers the highest annualized return in 5 months. This means that the so-called basis trade, in which a speculator purchases Bitcoin in the spot market and sells long-dated futures in order to lock in the difference between the two prices, has been reinstated. And it's occurring amid a Bitcoin price surge fueled by optimism that the Securities and Exchange Commission will soon approve the first US Bitcoin futures ETF. It's a pattern that repeats itself in crypto and is uncommon in other markets, according to Strahinja Savic, head of data and analytics at FRNT Financial. Individual investors are the primary drivers, as they use futures to leverage their positions and make price predictions. Crypto is unique in that it has a much higher retail participation rate than sophisticated institutional actors, who typically reduce exaggerated contango through arbs trade. Savage was referring to arbitration. Given the absence of those actors in comparison to other assets, BTC is prone to these aggressive contangos during bull markets. We believe this is an extremely undervalued and lucrative strategy in crypto. Futures typically trade at a discount to spot, a condition known as contango. Contango and backwardation are terms used to describe curve structures that represent traders' estimates of how much a particular contract might be worth in the future. Contango denotes an upward slope, whereas backwardation denotes a downward slope. Because there is no cap on futures open interest, futures in contango indicate that the supply of Bitcoin is plentiful, according to Steve Sosnick, chief strategist at Interactive Brokers. As long as sufficient traders post sufficient margin with a clearinghouse, Any two counterparties can initiate a trade and create a new futures contract, he explained. Many traders may be betting right now that a futures-based ETF will act as a significant forced buyer in the market. Whatever money flows into the product must be used to purchase futures contracts, the logic goes. A well-hyped new asset class is contractually obligated to purchase these futures, and traders are adjusting and front-running accordingly, he stated. While it is entirely possible that the market got ahead of itself, which is a risk in the crypto space, there is clearly a bet being made that new money will enter crypto via futures ETFs. To be sure, more traders may seek to profit from the spread, implying that it may narrow, according to Zhu Su of hedge fund 3 Arrows Capital. You're going to see a lot of capital flow into arbitrage because it's going to become very attractive. If you can earn 6% or 10% on dollars, there are a lot of guys who will cooperate, and to do that, the co-founder of the firm stated. All it takes is for one bank or one participant to invest a few $1 billion. It's not going to be that bad if you zoom out. Though it collapsed earlier this year amid a sell-off in cryptocurrency prices, the basis trade has been one of the most prevalent in the crypto industry. It is widely used by hedge funds due to its consistent ability to generate double-digit annual returns. The futures price is higher than the spot price, and this is where the big boys engage in a lot of arbitrage. According to Howard Greenberg, president of the American Blockchain and Cryptocurrency Association in Washington, D.C., and cryptocurrency educator at Prosper Trading Academy. They'll play the spread, they'll purchase the underlying asset at a discount, bid up the futures, and then sell into the market's strength. The spam attack by the Arbitrage bot on the Polygon network generated $6,800 per day. The growth of Layer 2 protocols has been one of the year's most significant stories, as the increasing popularity of decentralized finance, DeFi, and non-fungible tokens, NFT, has increased transaction costs on the Ethereum network, effectively pricing out many participants. Earlier this year, the Polygon network, formerly known as Matic, emerged as a leading contender in the race for an effective Ethereum Layer 2 scaling solution, and the project's QuickSwap DeFi platform was also a successful Uniswap clone. Polygon was initially quite popular, but as new platforms such as Arbitrum and Optimism emerged, discussions about the platform dwindled, and some traders even refer to it as slow. According to data from Flipside Crypto, the Polygon network's low-cost capabilities came under attack after a cleverly constructed arbitrage bot managed to convert 14 Ether into 218.5 Ether in less than 4 months. Each block was stuffed with meaningless transactions by the bot. According to data from Flipside Crypto, the attack began in early May and reached a peak of 8 million push transactions per day on the Polygon network in June. The maximum number of transactions on the Ethereum network was 1.2 million during the same time period. Transactions per second on Ethereum versus Polygon. According to data discovered on a Polygon forum, the attacker has been inflating transaction volumes by up to 90% by stuffing each block with meaningless transactions for as little as 0.02 Matic per block and roughly $1,000 per day. A deeper examination of the network's transactions and addresses revealed that approximately 30% of the network's transaction count came from 2 contracts that were determined to be arbitrage bots conducting thousands of daily transactions to various decentralized exchanges, DEX. The exact reason why the spammer chose to fill each block is unknown, but one theory is that it was done to prevent anyone else from front-running the trade. The bot generated an average daily profit of $6,800. Over a 120-day period, the bot increased the value of an initial 14 Ether to 218.5 Ether, which is currently worth $813,694. This equates to an average daily profit of approximately $6,800 before the cost of spamming the network is deducted. In response to the spammer, the Polygon team ultimately decided to increase the minimum transaction cost from 1 GUI to 30 GUI in order to combat spam and improve network health. The move appears to have accomplished its stated objective, as Delphi digital data indicates that the increase in average transaction costs coincided with a significant decline in daily transactions, as it now costs $30,000 to spam the network for an entire day. Spam transactions have decreased from 2 million to 500,000 per day, a 75% decrease, but they still account for 16.7% of daily transactions. This means that the bots are spending approximately $5,000 of their daily profit of $6,800 on gas to maintain the scheme. The global cryptocurrency market cap has finally surpassed $2.5 trillion. For the first time in 5 months, the global cryptocurrency market value exceeded $2.5 trillion. In recent years, the global cryptocurrency market has experienced considerable growth and income shifts. Numerous new cryptocurrencies have entered the cryptocurrency market, altering market conditions and investor preferences. Investors that believe in the future potential of cryptocurrencies have accounted for the majority of the present market capitalization, and this may continue to be the case until there is some degree of price stability and increased acceptance by more traders. Apart from the real price of the cryptocurrency, investors assess the cryptocurrency's inherent value, which includes the technology's popularity and the efficiency of the integrated network. Blockchain public ledger technology has the ability to revolutionize traditional payment systems by enabling new applications of virtual transactions while also improving security. By 2020, the pandemic would have impacted all facets of a country's economic and financial position. Additionally, the last year has been critical for cryptocurrencies and blockchain. Cryptocurrencies have demonstrated remarkable resilience in the face of such severe economic meltdowns. This demonstrates the cryptocurrency market's colossal potential for a big rebound. The overall market capitalization of cryptocurrencies recently passed the $2.5 trillion milestone and then fell slightly to $2.47 trillion. The reason for investors' renewed optimism as they continue to speculate on digital currencies is the assumption that the first Bitcoin exchange-traded fund will begin trading in the next week. According to CoinMarketCap, the entire market capitalization is currently $2.49 trillion, with a 24-hour worldwide market volume of $92.38 billion, a 9.23% rise. Bitcoin has performed admirably over the last few days. Since 2020, it has been a highly valuable item. BTC has made a major contribution to the cryptocurrency market's growth in value. MicroStrategy, the cryptocurrency's largest public holder, is one of the major winners of the bull run. According to reports, the corporation had 114,041 Bitcoin tokens worth an aggregate of $3.16 billion, which nearly doubled to $7 billion. How are Bitcoin and other cryptocurrencies contributing to the global cryptocurrency market capitalization's growth? Bitcoin, the world's largest digital currency, controls 45% of the worldwide cryptocurrency market. Ether, the second largest cryptocurrency, has increased by almost 1,000% in the last year. Similarly, the value of a large number of other cryptocurrencies has increased during the last year. However, what is producing this revenue increase? These digital currencies have recently been positioned as a safe haven from market instability and inflation. Public firms are increasingly changing their cash treasuries to cryptocurrencies. The current societal and economic landscape is creating a new situation in which individuals must store less cash and avoid market fluctuations. Even though the general public is hesitant to use it for transactions, many people wish to convert their cash to cryptocurrency because they feel its deflationary nature makes it a better store of value and protects their financial gains from market inflation. Apart from these factors, some brilliant software developers have focused their efforts to cryptocurrency mining, increasing the industry's depth, breadth, and market focus. According to experts, it would be stupid to suppose that the Bitcoin industry will be immune to further threats or crises. Without a doubt, it will face numerous obstacles. However, the market has demonstrated its resilience, demonstrating that it is capable of weathering any storm and facilitating a future financial revolution. What you need to know about decentralized cryptocurrency exchanges. Decentralized cryptocurrency exchanges operate independently of a third entity, enabling users to conduct peer-to-peer transactions. Exchanges of digital currencies are platforms that facilitate the trade of digital coins. This can be better appreciated by using the stock market as an example. Similarly to how stock exchanges facilitate the trading of equities, cryptocurrency exchanges facilitate the trading of virtual assets. Cryptocurrency exchanges are a relatively new concept, and many people are still unfamiliar with them. However, given the growing interest in cryptocurrencies among investors, it is critical to understand the various types of cryptocurrency exchanges. One such site is a decentralized cryptocurrency exchange. What exactly are decentralized cryptocurrency exchanges, DEXs? As the name implies, these exchanges run decentralized, free of third-party meddling. Users of decentralized cryptocurrency exchanges can conduct peer-to-peer transactions. This process is mechanized through the use of smart contracts. Nevertheless, not all decentralized exchanges share the same infrastructure. Uniswap, V2, Tokenlon, 0x Protocol, and Venus are all prominent instances of DEXs. Why would you choose DEXs? 1. Confidentiality. DEXs must be your first choice if you desire complete privacy because to their anonymity. While centralized cryptocurrency exchanges may request Know Your Customer (KYC) information, DEXs operate anonymously. 2. It is reasonably priced. Centralized exchanges incur significant costs in terms of establishing and maintaining infrastructure necessary to provide secure services. While decentralized cryptocurrency exchanges operate on the concepts of automation and self-regulation, which makes them more affordable in comparison. DEXs would assist you in reducing all additional charges. 3. There is a lower chance of hacking. Hacking is virtually impossible with a decentralized exchange. This is the greatest option if you are an investor who is most concerned about hacking threats. You are not required to exchange assets with a third party, which makes it less vulnerable to hackers. 4. Financial self-sufficiency. You maintain complete control of your wallets and funds. It does not require you to transfer funds to a wallet or trading account in order to conduct transactions. After all, just like with a centralized trading platform, having an e-wallet adds dangers. Having said that, decentralized exchange does have several drawbacks, one of which is that it does not commence the trade of fiat currencies. In comparison to centralized exchanges, decentralized cryptocurrency exchanges lack user-friendly features. DEXs can be somewhat complicated. Therefore, make an informed decision. By 2030, crypto-ATMs will have increased by 60%, but there is a catch. The pandemic of COVID-19 appears to have bolstered the global cryptocurrency ATM sector. According to Allied Market Research, the crypto-ATM market is predicted to grow at a roughly 60% compound annual rate through 2030 as a result of greater adoption. According to the analysis, the trend established in 2020 is projected to continue in the post-pandemic market. Additionally, the survey anticipated that the global ATM industry will be valued at $35.80 billion in 2020. The figure is predicted to reach $3.55 billion by 2030. Allied Market Research predicts that additional technical breakthroughs will pave the way for lucrative prospects in the business. In 2021, when Visa and MasterCard entered the crypto space, the same thing happened. Indeed, numerous platforms, including BlockFi, are now issuing crypto credit cards as a result of institutional agreements. Like internet transactions, crypto ATMs require users to undergo Know Your Customer (KYC) verifications. When a user operates an ATM, the user's public and private keys are automatically included on the receipt. Like internet transactions, crypto ATMs require users to undergo Know Your Customer (KYC) verifications. When a user operates an ATM, the user's public and private keys are automatically included on the receipt. It's worth mentioning, though, that the survey cited convenience and shortened transaction times, as well as security and transaction flexibility, as growth drivers for crypto ATMs. There is, however, a catch. The ATM industry will be restricted until more nations, such as El Salvador, recognize bitcoins as legal cash. Additionally, the survey discovered that the market's expansion is hampered by a scarcity of ATMs and kiosks. On the other hand, as more entrepreneurs and institutional investors enter the industry, there is a likelihood of a push for the crypto ATM market. Currently, the United States has close to 26,000 crypto ATMs, accounting for approximately 85% of the global total. Indeed, September alone witnessed a 6.8% increase in the figure. The United States is followed by Canada, which accounts for 6.6% of the global ATM market. El Salvador comes in second place, with a 0.7% market share with ATMs in over 200 locations. As a result of El Salvador's policy decision, ATM manufacturer Chivo ATM allegedly deployed its first 230 ATMs in September. Genesis Coin, on the other hand, continues to be the global leader, with over 11,000 ATM installations, as operators continue to experience a boom in revenue. It's also worth noting that the majority of these machines accept Bitcoin as a cryptocurrency, with only a few accepting alternative cryptocurrencies. Crypto scammers take over the iPhones of dating app users. Cryptocurrency scammers have been busy amassing millions of dollars at the expense of iPhone users only looking for romance on dating apps. Wherever there is substantial profit to be made, fraud seeks to swindle its way into the promised land. This year has seen an uptick in scammers. They pose a genuine threat to cryptocurrency users. It's not just about the money, their personal information is also at stake. Sophos, a British cybersecurity firm, has been investigating these romance-themed scams and has assigned them the code name crypto-ROM. According to Sophos, individuals have lost between $25,000 and $87,000 by trusting scammers who contacted them via dating apps. On a grander scale, one of the scammers' Bitcoin addresses had a whopping $1.38 million. This number can be multiplied by all the other unknown scammer addresses. Sophos had previously been monitoring these types of scams in May, but the situation has deteriorated. The hackers have spread from Asia to the United States, the United Kingdom, France, and Hungary, indicating that the threat is only increasing as they gain territory and power. These con artists have amassed sufficient knowledge of social dynamics to amass millions across 3 continents. The crypto-ROM scammers take use of Apple's enterprise signature program, which is used to develop mobile applications. As a genuine cyber parasite, they take complete control of the victim's iPhone, allowing them to fully administer it and install other hacking programs. As Sophos explains, when an iOS device user visits one of the scammer's websites, their device downloads a new profile. Instead of a standard ad hoc profile, an MDM provisioning profile is downloaded that is signed with an enterprise certificate. The user is prompted to trust the profile, and once they do, the thieves can manage their device based on the contents of the profile. The modus operandi of the crypto scam. Scammers may not appear to be such at first glance. They now take the time to become acquainted with the victims. Certain assailants frequently disguise themselves as celebrities. Sophos has also broken down the crypto-ROM scammers' operation into 5 parts. They begin by creating a convincing profile. The most popular sites are Tinder, Bumble, Grindr, and Facebook dating, and then approach the victim and request to chat via another communication service, such as WhatsApp. They then request that you download a cryptocurrency trading app. The hackers initially acquire the victim's trust by allowing them to withdraw a fictitious profit. The final stage of the fraud is to deny the victim access to their funds, followed by money removal. What begins as a simple conversation becomes into a billionaire fraud. For some time, the Federal Trade Commission, FTC, has been warning about the rapid growth of these scams. They provided some self-defense suggestions earlier this year. Check it out before you invest. Conduct an online search for the company's name and the cryptocurrency's name, as well as terms such as review, scam, or complaint. Take a look at what others are saying. As Bitcoin values continue to rise and the world transitions to a largely digital economy, scammers will grow more crass and inventive in their approaches. It is critical to avoid unverified applications and investment promises that seem too good to be true. Why fractionalized NFTs are the next big trend. What is the purpose of the NFT frenzy? Experts have made the following smart observations. NFTs enabled demonstrable digital scarcity that no one could violate and inherently granted the owners of the NFTs complete ownership and transfer rights. Developing an emotional relationship to something does not have to be contingent on visual fidelity or any other tangible quality. The value associated with non-fungible tokens is expanding beyond the value associated with blockchain-based images or content. Interest in the NFT market has increased dramatically since the beginning of the year. There is no indication that the rate of innovation would slow anytime soon, given the fresh concepts offered in the field. Analysts predicted that in the future, during the era of fractionalized NFTs and the metaverse, NFTs would generate larger returns than cryptocurrencies. The last 9 months have been nothing short of amazing in the field of cryptography. As the full value and utility of non-fungible tokens, NFTs, became apparent, the market for these one-of-a-kind blockchain data units grew enormously popular. Should you conduct a search for NFTs? These metrics provided by Perugia, the pseudonymous $7.5 million CryptoPunk buyer. How much worldwide demand is there for scarce assets? How likely is it that the most valuable assets in the future will be digital? How likely is it that the earliest NFTs will be regarded as the most scarce? Considering the cryptocurrency space, I believe the NFT space will generate and integrate with the world's wealthiest people. You may wonder why, but why not? NFTs are distributed extremely fairly, and CryptoPunks are more rare than Bitcoin. Even a small amount of faith in innovation would lead you to believe that NFTs will become more valuable in the future. Between $20 and $30 billion in main sales. For the record, Wasari researcher Mason Nystrom estimates that overall secondary NFT market sales recently exceeded a threshold of $10 billion and approximately $20 to $30 billion in combined primary sales. These figures demonstrate the increased amount of investor interest and appetite for NFTs. The majority of sales came from collections of crypto arts, particularly CryptoPunk. Although punks have existed for over 4 years, they only got widespread attention this year as a result of growing interest in the general NFT industry. Matt Hall and John Watkinson started this collection of 2,424 8-bit style pixel art images as an experiment, but it quickly established a market for crypto art. Surprisingly, when these highly sought-after crypto artworks were first made public in 2017, just a few people took notice. Meanwhile, only roughly 20 to 30 CryptoPunks were purchased after the first week of debut, despite the fact that they were significantly less than the current market value. The answer was presumably because many people were unaware of or uninterested in the possibilities of CryptoPunk. At the time, the majority of interest in NFTs was directed on CryptoKitties. However, things changed after Mashable published a story headlined "This Ethereum-based project may transform the way we think about digital art." Fast forwards to the present, the majority of CryptoPunk content has sold for hundreds of thousands of dollars, many for over $1.5 million in response to the NFT market's demand. This tendency benefits early investors who purchased characters from the exact 10,000 CryptoPunk works of art. Unfortunately, based on the current pricing, CryptoPunk appears unaffordable to many, particularly retail investors. The market for NFTs continues to expand. If you were unable to acquire one of the characters prior to the NFT market's frenzy, you have sadly lost out on a big profit-making opportunity in CryptoPunk. However, there are rumors that CryptoPunk will become far more valuable in the next years. On a more general note, though, the non-fungible token market is still flourishing and has only just begun. Many believe that the market still has a lot to offer, and that the popular collection type and single NFTs are merely a gateway to more opportunity. Several factors contribute to the NFT market's continued growth. Scarcity. The cryptocurrency market, particularly Bitcoin, is also influenced by the suspense associated with scarcity. More individuals are lured to the asset with the highest market value. This is due to the fact that there will only be 21 million BTC available. This is also true for other cryptocurrencies, and NFTs are not excluded. Cryptographic arts are non-fungible and are the rarest type of asset. Given the monetary value of Leonardo da Vinci's Mona Lisa painting as the scarcest asset, do you believe NFTs will not capitalize on the growing demand for rare artworks in light of the global transition to the digital era? I believe that NFTs will succeed. Every other kind of art is commercialized and monetized. Why should GIF/interactive/digital art be any different? NFTs are the only suitable media for this purpose. There is no other decentralized method to accomplish the same thing. I am convinced that NFTs are the future of digital art, stated Sutton, a Spanish NFT curator and collector. Fundamental value and concept: investors will continue to invest in NFTs due to their fundamental value and concept. Numerous people are interested in paintings, trading cards, and other collections, despite the fact that these items can be copied. They purchase these physical objects not because they are less expensive, but because they are interested in and value them. Do you believe that the trend will continue to shift towards NFTs in the future, given their significantly greater value proposition? Managing the legitimacy and establishing ownership of NFTs in a decentralized fashion was previously inconceivable. Metaverse: the application of NFTs in the metaverse will provide crypto users with additional exciting prospects. The term metaverse is a relatively recent notion that refers to an enhanced augmented reality environment on the internet in which individuals can interact with digital assets, which may include NFTs. Additionally, this paper discussed how NFTs might be integrated into a revenue model in the coming metaverse, thereby extending their utility and value. Soon, new breakthroughs and meaningful endeavors will explode in value beyond anything CryptoPunk could achieve previously. Several of these new prospects have already materialized. As usual, they are insignificant to the point where consumers pay little attention until prices increase. Fractionalized NFTs fly to new heights. Fractionalized NFTs, particularly the B20 token or tokenized fractions of 20 digital artworks produced by popular American NFT and digital artist people, will be one of the next big trends in the cryptocurrency market. To fractionalize non-fungible tokens, the owners encrypt the primary content with a smart contract. Then, they issue 2 or more tokens that, when combined, reflect the value of the content. According to reports, this concept originated with the B20 project, which is still relatively young in the non-fungible token market. PleaserDAO uses this strategy to resell the official Dogecoin meme NFT in tokens. Fractionalizing an NFT, for example, decentralizes ownership and enables more substantial price discovery and accessibility. Due to the tokenization of value, more individuals will be able to afford and speculate on the price, as opposed to a pricey NFT content from Beeple or even CryptoPunk. Notably, the perception that fractionalized NFTs separate cryptographic arts is not entirely accurate. More individuals are likely to follow this market if the story is shifted somewhat to include altcoins created by NFTs. We cannot overlook the reality that some people are unfamiliar with and unmoved by crypto art. They will, however, go to any length if the transaction includes Bitcoin, which they understand. B20 has the ability to eclipse CryptoPunk. In 2020, Beeple, formerly known as Mike Winkelmann, sold a collection of 20 cryptographic works to Metaverse for $3.2 million. The business, which is now the largest NFT fund, has locked these artworks in a smart contract as part of the B20 initiative, fractionalizing the 20 contents into B20 tokens. B20 can legitimately be compared to CryptoPunk in this nascent segment of the NFT market. As CryptoPunk was instrumental in establishing the crypto art movement, B20 is a pioneering initiative for fractionalized NFTs. This project establishes it as one of, if not the most, promising undertakings in this section. What makes B20 more intriguing? It possesses tangible, intrinsic worth. Beeple is widely regarded as the most notable digital artist working in the NFT realm, as seen by the high bids on his artworks. Beeple earned approximately $70 million earlier this month from the sale of his collection of 5,000 cryptographic works, Every Days, the first 5,000 days. In this aspect, B20 tokens are primed for tremendous growth as more people become aware of Beeple's collectibles. Apart from these fundamentals, the tokens may spontaneously tap into the NFT frenzy. Numerous projects benefited from the market's frenzy. As a result, B20 is not restricted. Although the rush began earlier this year, many analysts anticipate the climax is still to come, driving up the price of NFTs even further. On the horizon, a price of $25 to $30. According to the market value of Beeple's artworks that are locked in the smart contract, the B20 tokens are currently trading lower than they should. The price has decreased dramatically since reaching an all-time high in March of this year. However, taking into account all of the scenarios discussed previously, the bull market, which is likely to begin this November, is expected to reclaim the $25 to $30 price level in the spring of 2022. Consider how much early NFT projects like CryptoPunk increased in value as a result of the market's flood of interest. NFTs are not soaring like the dot-com bubble, which suggests that other novel concepts have the potential to soar when the market resumes its upward trajectory. Verdict: I'm now convinced that the returns on NFTs can be significantly higher than those on cryptocurrency in general, and that these returns are, far from being irrational and based on mere greater fool theory hype and bubbly fadness, are actually extraordinarily justified for a few select investments, said Ben Yu, co-founder of Stream Token. His vision is not implausible. The majority of marketplaces for NFT art have already incorporated their royalty code into the smart contracts used to mint NFTs for creators. There is an Ethereum improvement proposal pending to establish a common standard for royalties in smart contracts that create NFTs. These royalties will continue to exist in perpetuity, as specified in the code that resulted in the creation of the NFT representing the artwork. The immutable smart contract will ensure that if the artwork's value grows in the future, the artist or his inheritors will receive a 10% royalty on all secondary sales. Artists are guaranteed continuous revenue generation through code that will exist in perpetuity on the blockchain. Your objective should be to guess on adoption for the time period covered by your time horizon. Additionally, if you are a firm believer in everything that the blockchain has created, it would be wise to invest in fractionalized NFTs such as B20. Crypto discovers how to play the DC influence game. Faced with a dizzying array of new legislative and regulatory action emanating from Washington, D.C., the crypto industry is reacting in the same way that any cash-rich industry would. It is attempting to solve the problem by throwing money at it. Established trade associations are beefing up their lobbying operations, and individual companies looking for more personalized service are hiring their own representatives from DC's vast pool of Congress whisperers and regulator persuaders. The cryptocurrency industry is a latecomer to the game. Crypto companies have largely avoided engagement with Washington, with the exception of a few well-established trade groups and some firms that recognized the importance of having a seat at the federal table before it became painfully obvious. According to Miller Whitehouse Levine, policy director for the DeFi Education Fund, a new Washington, D.C.-based organization aimed at educating policymakers about the benefits of decentralized finance and governance, the industry has suffered from a short-sighted lack of commitment to, and investment in, Washington. The lack of engagement was due in part to the deep vein of libertarian sentiment that runs through the crypto world, and in part to wishful thinking. There's obviously a pretty anti-centralized authority streak throughout the industry, White House Levine said, and the US government is the biggest, baddest, most centralized entity in the world. In the crypto industry, there's just a natural aversion to engaging with it. At the same time, he added, there was a misguided belief that crypto would fly under the radar of government regulators, similar to how internet companies did in the early days of the World Wide Web. That has not been proven in any way, he stated. A jarring awakening. It's difficult to pinpoint a specific point when the industry realized it needed a stronger presence in Washington. For some, it was as recently as 2019 that Facebook CEO Mark Zuckerberg faced intense congressional opposition over the company's plans to launch a stablecoin called Libra, since renamed Diem. For others, it was in December, when outgoing Treasury Secretary Steve Mnuchin proposed a rule that would have prohibited many anonymous cryptocurrency transfers. But for most, it was this summer, when the crypto industry was rocked by the news that an amendment attached to a bipartisan infrastructure spending bill would raise $28 billion in taxes from the industry by requiring cryptocurrency brokers to report transactions to the IRS. The problem was that the legislation's definition of broker was so broad that it would have included Bitcoin miners and software developers working on digital wallets. The outcry raised by industry representatives in Washington was sufficient to persuade a number of influential members of Congress that the legislation needed to be changed, though a final version of the bill is still pending. The infrastructure bill fight proved to a lot of people who weren't paying attention to DC that DC is paying attention to crypto, said Neeraj Agrawal, communications director at CoinCenter, one of a few crypto-focused organizations that has been on the front lines of federal policy battles for years. The crypto industry as a whole realized it needed to beef up lobbying efforts, or policy will be left to congresspeople who may not fully understand the technology, as evidenced by some of the language put into the infrastructure bill, said Nisa Amoyles, a securities lawyer and managing partner of A100X Ventures. The infrastructure fight, in particular, woke everyone up. Ron Hammond, Director of Government Affairs for the Blockchain Association, agreed. He described the effort to change the language in the infrastructure bill about brokers as a unifying moment for the industry's lobbying representatives. The core group of subject matter experts and lobbyists just said, "We have to get together on this front," he said. We all joined forces to form a large, powerful voice. Regulation of stablecoins is looming. The industry's recognition that it can successfully wield influence on Capitol Hill comes at a time when cryptocurrency is facing a slew of new legislative and regulatory challenges. In addition to the infrastructure bill, the President's Working Group on Financial Markets is nearing completion of a set of highly anticipated recommendations that will guide the regulatory treatment of stablecoins. Gary Gensler, the head of the Securities and Exchange Commission, is taking every opportunity to say that he believes crypto markets should be regulated by the SEC, and the Federal Reserve is about to release a report indicating whether or not the federal government should launch a central bank-backed US dollar coin. The industry is most likely to see clarity on how the government will treat the $100 billion-plus stablecoin market soon. The President's Working Group's findings could be delivered at any time, and they will be in the form of recommendations rather than hard and fast rules. According to Tayana Baker-Taylor, Chief Policy Officer of the Chamber of Digital Commerce, a regulatory framework for stablecoin issuers could be put in place within the next 12 to 18 months. When regulators and/or lawmakers transform recommendations into actual policy, DC lobbyists really earn their fees. Circle, whose USD coin, USDC, is the market's second largest stablecoin, is also increasing its lobbying efforts. Circle's goal has always been to be regulated, as the company's founder and CEO, Jeremy Allaire, has stated for years. However, the path to regulatory certainty is difficult, made more difficult by Circle's main competitor, Tether, and its eponymous dollar-denominated stablecoin. Tether has spent years arguing with regulators and law enforcement about whether it truly has the reserves needed to back up its nearly $70 billion market capitalization. In addition to attempting to distance its client from Tether, Circle must allay the Biden administration's concerns that stablecoins and other digital assets make it easier for perpetrators of ransomware attacks to escape with their victims' money. We will continue to advocate for effective policies that position the United States as a global leader in promoting the development of new digital economic infrastructure. We know that, as with the creation of the Internet, only through rigorous public-private sector collaboration will people everywhere be able to tangibly benefit from public blockchains, and we are engaging with policymakers to make that a reality, Circle's Chief Strategy Officer and Head of Global Strategy, Dante Disparte, said in a statement provided to CoinDesk. More money, fewer issues. Even before the infrastructure bill was revealed and the debate over stablecoin regulation heated up, the industry was beefing up its lobbying efforts. Lobbyists who work with Congress are required to file regular disclosures outlining who they work for, how much they are paid, and what specific issues or pieces of legislation they are working on. Open Secrets, a government transparency organization, compiles the data into a searchable database. According to the database, the Blockchain Association spent $290,000 on in-house and outside lobbyists in 2020. It spent $290,000 this year as of the end of June, the most recent filing date. Another lobbying group, the Chamber of Digital Commerce, spent $120,000 in 2020 and listed only one in-house lobbyist working on its behalf. The organization had already spent $92,000 by June 2021 and listed 4 lobbyists, 3 of whom were from the firm F's Vector, which began representing the chamber in April. Individual companies seeking bespoke representation have been adding both internal and external lobbyists to their teams, in addition to increased spending by trade groups. Coinbase has increased its lobbying spending every year since 2017, and spent $230,000 last year. It had already spent $160,000 and increased its roster of registered lobbyists from 7 to 9 by June of this year. Ripple Labs, which planned to spend $330,000 in 2020, has already spent $550,000 through June. Since 2019, the firm's lobbyist roster has more than doubled, from 6 to 12. The company is well aware of the dangers of Washington, having been taken to court by the SEC last year over sales of its XRP token, which the agency claims amounted to an unregistered securities offering. The third quarter spending figures have not yet been released, but the trend is clear. Several new disclosures have been filed in the months since the infrastructure fight began, documenting new lobbyist hires by crypto firms and trade groups. It was many people's first time hiring a lobbyist. Hedera Hashgraph, for example, has been represented by Keybridge Advisors since August 31st. Brett McDowell, executive director of the Hedera Council, explained the organization's thinking in a statement provided to CoinDesk, saying, "The council members and the broader Hedera community have an interest in ensuring that legislators and regulators, in the United States and elsewhere, are well informed about distributed ledger technology and the broad range of issues faced by those who are building valuable businesses that leverage the technology or otherwise participating in the technology." Another newcomer is Digital Currency Group, the parent company of CoinDesk, which hired its first lobbyist, the Klein/Johnson Group, in April and Capital Council in August. Not all attempts to sway federal policymakers take the form of traditional lobbying operations. Andreessen Horowitz, A16Z, recently launched a new $2.2 billion crypto venture fund, which has hired former federal prosecutor Katie Horn, who investigated the Mt. Gox hack, Bill Hinman, former director of the SEC's Division of Corporation Finance, Tomika Tillerman, a former advisor to Joe Biden and Hillary Clinton, and Brent McIntosh, a former Treasury Department official who specialized in digital asset regulation. While none of A16Z's new hires are officially lobbyists, several are expected to travel to Washington this week for meetings with the administration and Congress. The goal was to raise awareness of A16Z's lengthy proposal for regulating Web3, which it defines as a group of technologies that includes blockchain, cryptographic protocols, digital assets, decentralized finance, and social platforms. Coinbase also revealed last week what some of its recent policy hires have been up to. The largest crypto exchange in the United States by daily trading volume, which went public this year, has released a model regulatory structure for the crypto industry. The proposal called for digital assets to be separated from existing financial regulatory structures by establishing a single regulator for digital asset markets. According to Coinbase Chief Policy Officer Faya Shirzad, the goal is to start an open and participatory national conversation about the future of our financial system. It's a cash grab. There are indications that not all of the money pumped into Washington by the crypto industry is being spent wisely. Experts at some of the established advocacy groups expressed surprise at the large number of lobbying firms hired, owing to the small number of lobbyists with true expertise in the subject matter. Lobbyists, on the other hand, can be extremely persuasive. There's a big money industry, and lobbyists are really good at spotting opportunities. It's not surprising to me that a marriage is taking place there, said Agrawal of Coin Center. However, while lobbying firms may talk a good game on conference calls with potential clients, the rubber meets the road in the halls of Congress. There, the results of the most recent spending spree have been erratic, to say the least. Right now, it's a bit of a cash grab, said one Capitol Hill staffer who works on crypto issues. According to the staffer, many of the newly minted crypto lobbyists have no idea what they're doing. I deal with people all the time who aren't good at their jobs, and it's painful for some of the newer folks, the staffer explained. I don't want to have to explain to you how to do your job, and you get paid for it. The staffer advised industry participants seeking representation in Washington to understand that a good lobbyist may have to tell clients things they don't want to hear. If this does not occur, it is prudent to maintain a healthy level of skepticism. Another Hill staffer familiar with crypto issues stated that it is clear that some of the companies hiring lobbyists right now are prioritizing access over subject matter knowledge. They're hiring people with good foundational lobbying experience and teaching them as they go, a staffer explained. Resource maximization. Baker Taylor of the Chamber of Digital Commerce compares the current situation to the market for legal representation that crypto companies faced several years ago. 5 years ago, everyone was looking for lawyers to guide and advise them, she explained. And we were all aware that the lawyers were learning on the job. There are two components here, she explained. There is a level of technical and commercial detail in understanding the subject matter that you are advocating for. This is crucial. Then there's the matter of comprehending how Washington operates. And I believe that while there are people who excel at one of these, there aren't many who excel at both. That, I believe, is part of a maturing industry. According to White House Levine of the DeFi Education Alliance, crypto companies should be more cautious about who they hire to represent them. You can't just hire a lobbying firm in DC and then forget about it except for the monthly retainer. To maximize those resources, massive amounts of education will be required before lobbyists can be relied on to get out there and educate. The DeFi Education Alliance is in the process of hiring lobbyists, according to White House Levine, and it is doing so on purpose. We put together a briefing book of DeFi 101 readings that ended up being 450 pages that we're going to ask our firms to read before we start, he explained. We also plan to run a 5-day sprint curriculum to get our lobbyists up to speed. The good news is that once those lobbyists are up to speed, they will find a willing audience among many members of Congress who, only a few years ago, refused to discuss crypto issues. Early on, most members on the crypto lobbying side didn't want to go down the rabbit hole, said Hammond of the Blockchain Association. It was just so complicated and intimidating to know you had to invest so much time into it. But it's now getting to the point where they realize they need to learn about this issue. There is as much outreach coming from Congress as there is going the other way these days. It's not so much me reaching out as it is the opposite, he said, noting that congressional offices have asked the industry to assist in educating senators and members of Congress on the issues. On both sides of the aisle, there's a strong desire for education, Hammond said. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.